If you're looking to get ahead of the game and snag some stocks that could pop off in the next few months, you're in the right place. Today, we're diving into 5 undervalued stocks to buy before Q3 2025 earnings. These are companies the market's sleeping on, but they've got serious potential to shine when those earnings reports drop in October 2025. Why should you care? Well, undervalued stocks are like finding a designer jacket at a thrift store. Buy low now, and you could be sitting pretty when the market catches up. I've done the homework, digging into data from Morningstar, Yahoo Finance, and company reports, so you don't have to. We're talking detailed analysis, growth potential, and even the risks you need to watch out for. So, grab a coffee, hit that like button, and let's get into it. First up, we've got Alphabet, ticker Google, the tech giant behind Google, YouTube, and Google Cloud. Now, you might be thinking, Alphabet? Undervalued? Isn't that the king of tech? Well, hold up. Morningstar says it's trading at just 65% of its fair value. That's like getting a Ferrari for the price of a Toyota. Here's the deal. Alphabet's got what Morningstar calls a wide economic moat. That means it's got a huge competitive edge. Think Google search dominating 90% of the market or YouTube being the go-to for video. Plus, Google Cloud is growing like crazy, with 28% year-over-year revenue growth in Q1 2025, hitting $10.2 billion. That's huge. For Q3 2025, analysts are expecting revenue of $97.11 billion, up 10% from $88.27 billion last year, and earnings per share of $2.25, up 6% from $2.12. Those numbers come straight from Yahoo Finance's June 2025 consensus. Alphabet's also leaning hard into AI, with stuff like Gemini 2.5 and AI overviews, which are already reaching 1.5 billion monthly users. That's a big reason why their Q1 2025 revenue of $90.23 billion crushed expectations. So why is it undervalued? Well, the market's freaking out about AI competition, like, what if OpenAI steals Google's thunder? And there's always regulatory noise about monopolies. But let's be real. Alphabet's been innovating for decades, and they're not slowing down. The risk? Sure, regulators could slap them with fines, or a new AI player could shake things up. But at 65% of fair value, this feels like a steal for a company that's basically the backbone of the internet. Next up, Pfizer, ticker PFE. Yep, the pharma giant that saved the world with its COVID vaccine. Right now, it's trading at 60% of its fair value, according to Morningstar, with a wide economic moat. That's a screaming deal for a company with such a strong track record. Now, Pfizer's had a rough patch since the COVID vaccine hype died down. Analysts are forecasting Q3 2025 revenue at $17.11 billion, down 3.33% from $17.7 billion last year, and EPS at 86 cents, down from $1.06. Not exactly lighting the world on fire, right? But here's the thing. The market's obsessing over the COVID revenue drop and missing the bigger picture. Pfizer's got blockbusters like Eliquis for blood clots and Vyndaqel for rare diseases, which are growing like gangbusters. Their pipeline's also stacked with new drugs for cancer and rare conditions. In December 2024, they dropped guidance for 2025, projecting $61 to $64 billion in revenue. And that's without leaning on COVID products. That's from their official press release, by the way. Why is it undervalued? The market's still hung up on the post-COVID slump and maybe some global trade worries. But with a pipeline this strong and a valuation this low, Pfizer could surprise to the upside. Risks? Sure, if vaccine sales keep tanking or trade tensions spike, it could hurt. But at 60% of fair value, I'm thinking this is a solid long-term play for patient investors. All right, let's switch gears to energy with ExxonMobil, ticker ExxonMobil. This one's trading at 87% of its fair value, per Morningstar, so it's not as dirt cheap as the others, but it's still a bargain. It's got a narrow economic moat and high fair value uncertainty, mostly because oil prices can be a roller coaster. For Q3 2025, analysts are expecting an EPS of $1.68, down from $1.92 last year, according to Yahoo Finance. I couldn't find a revenue consensus, but their Q3 2024 earnings were $8.6 billion, so that gives us a baseline. Exxon's been killing it with cost-cutting and boosting production in places like the Permian Basin and Guyana. Their Q1 2025 results, announced in May, showed they're pumping out oil like nobody's business while keeping a rock-solid balance sheet. They're also returning cash to shareholders like it's going out of style, think dividends and buybacks. That's a big deal for income investors. So why is it undervalued? The market's nervous about oil price swings and all this talk about transitioning to green energy. But oil's still king for now, and Exxon's operations are lean and mean. Risks? Oil prices could crash, or geopolitical drama could mess things up. But at 87% of fair value, Exxon's a strong pick if you believe energy demand's sticking around. Plus, who doesn't love a dividend check? Now, let's talk about Ally Financial, ticker Ally, a digital banking player that's flying under the radar. Morningstar has it at 78% of fair value, and while it doesn't have an economic moat, it's crushing it in the online banking space. For Q3 2025, analysts are forecasting an EPS of $1.01, up from 95 cents last year, per Yahoo Finance. Revenue numbers are harder to pin down, but Q3 2024 revenue was $2.1 billion, up 6.9% year over year. Ally's riding the digital banking wave, with a growing loan portfolio and a deposit base that's expanding fast. Their Q1 2025 earnings showed an adjusted EPS of 58 cents and $10.2 billion in consumer loan originations. That's solid growth for a bank nobody's talking about. Why is it undervalued? The market's worried about credit quality, basically, people defaulting on loans if interest rates keep climbing. But Ally's digital-first approach and focus on auto loans and savings accounts make it a standout. Risks? Higher rates could squeeze borrowers, and that's something to watch. But at 78% of fair value, this feels like a hidden gem in the financial sector. Last but not least, Kraft Heinz, ticker KHC. This one's trading at just 57% of its fair value, making it the cheapest on our list with a narrow economic moat, per Morningstar. That's a crazy discount for a company with brands like Kraft, Heinz, and Oscar Mayer. For Q3 2025, analysts expect revenue of $6.2 billion, down 2.83% from $6.38 billion last year, and EPS of 64 cents, down from 75 cents, per Yahoo Finance. Not exactly screaming growth, but hear me out. Kraft Heinz is tackling volume declines with cost-saving moves and new products. Their Q1 2025 results, announced in April, showed they're doubling down on innovation to keep those iconic brands fresh. Why is it undervalued? The market's spooked by competition from cheaper private label brands and consumers trading down to save money. But Kraft Heinz's global reach and brand power are hard to beat. Risks? If volume keeps slipping or inflation squeezes margins, it could hurt. But at 57% of fair value, this feels like a safe bet for value investors who love a good deal. Why buy before Q3 2025 earnings? These companies are sitting at discounts, and their earnings reports could be the spark that drives their prices up. Alphabet's AI growth, Pfizer's pipeline, Exxon's production, Ally's digital banking, and Kraft Heinz's brand power all have catalysts coming. But timing matters. Get in before the market wakes up. Now, let's keep it real. Investing isn't all sunshine and rainbows. These stocks have risks. Alphabet's got regulatory heat and AI competition. Pfizer's dealing with a post-COVID hangover. Exxon's tied to oil prices, which can be wild. Ally could get hit by loan defaults if rates spike. And Kraft Heinz needs to fend off those pesky private labels. I'm not a financial advisor, so do your own research before throwing your hard-earned cash into any stock. Check your risk tolerance and maybe talk to a financial advisor. The market's unpredictable, and macroeconomic stuff like inflation or geopolitics could shake things up. But the data says these stocks are undervalued for a reason, and that's where the opportunity lies. And there you have it, 5 undervalued stocks to watch before Q3 2025 earnings. Alphabet, Pfizer, ExxonMobil, Ally Financial, and Kraft Heinz are all trading at discounts, and their earnings could be the moment they shine. What do you think? Are you eyeing any of these stocks? Or do you have another undervalued pick on your radar? Drop it in the comments below. I love hearing from you guys.